Today we're looking at IPOs on Torpedo Tuesday. We're looking at the heavily promoted IPO for Latitude Financial, and Hugh Dive from Atlas Funds Management is walking us through. Good morning, Hugh.
Good morning, Chris.
There are a lot of brokers behind this IPO, almost to the point that there's no one left for an objective or unbiased view. How many firms are involved with Latitude?
There's around about 13 different brokers, investment banks, and large financial advisory firms. There's a lot of fees on offer on this particular one, so it's going to be sold very hard. There's not going to be a lot of critical research put out over the next month or two.
So a lot of firms singing the same tune.
Very incentivized for this particular IPO to get away. Yeah.
Well, we'll look at this through the lens of how you're allocating the funds that you manage and whether you'll be buying the IPO. But first, let's go for a prudent reminder from Benjamin Graham's words on IPOs. And it's best summarized that he advises investors to be wary because the selling time is chosen by the vendor. So they're choosing exactly when to sell, and that's to their benefit, no doubt. And also the heavy salesmanship involved in the delivery of the IPO. Two aspects that we'll look at when you dissect this IPO. And to kick us off, can you tell us where Latitude's come from, Hugh?
So Latitude Financial is the rebranded GE Money, which was acquired by two private equity firms, KKR and Värde and Deutsche Bank, in sort of 2015. So GE Money is a consumer finance business, which managing products such as Myer credit cards, car finance, their own branded credit cards, and most importantly, point of sale finance at stores such as Harvey Norman, Apple and JB Hi-Fi. So Latitude currently have a loan book of around about $9 billion in consumer finance.
You're mentioning GE here. Is that the same well-known firm that we hear reporting on in the US markets?
Yeah, so GE is General Electric. It was a massive US conglomerate. It was one of the 12 founding companies listed in the Dow Jones in the first year of its listing in 1896. So GE is probably more famous for its heavy engineering products, such as giant power turbines, offshore oil and gas platforms, as well as everyday items such as light bulbs. So consumer finance may seem a bit of a strange business for a company to be involved that makes offshore oil rigs, but effectively what this business has been a capital arbitrage play. So GE Money was able to leverage off the parent's credit rating, which was previously AA, to borrow cheaply in the wholesale markets, often more than they needed to finance their industrial activities, and then lend that onto customers. However, GE obviously was not a bank, so there's no deposit base.
It sounds like a pretty solid plan. So should we expect to see BHP and other strong balance sheets follow suit?
Very unlikely, Chris. So in 2008, this GE capital model was tested and almost failed. So when the crisis hit in 2008 with the GFC, GE Capital, with about a third of its funding needing to be rolled on the short-term money markets, when those money markets were shut, they had no option but to seek help from the US government. Obviously, for potential Latitude shareholders, that option is not available in future crises. So, yeah.
And now that we look at Latitude, they're obviously in the lending space. Can you give us a bit more detail on how that business works?
So Latitude's business model is relatively simple, not dissimilar to Clydesdale that we spoke about last week. Latitude effectively lends money to customers at a higher rate than they pay to borrow it on the wholesale market, so retail to wholesale arbitrage, and their profit is the margin between what Latitude can borrow on the sort of the global money markets, and then what it lends out less the cost of actually doing the business, like performing the loans, and also some bad debts from unrecoverable loans. So Latitude's customer base is typically a customer who owns below $40,000 and does not have access to bank credit cards.
So are there any examples where a listener might have seen a transaction or walked into a store and seen that you could tell us how that works?
So one of the principal ways that Latitude sort of has a transaction is they offer interest-free finance in a store such as Harvey Norman. So Latitude will make money by charging a fee to a merchant such as Harvey Norman to establish an interest-free loan where they're, say for example, offering a 12-month interest free on a TV. where Latitude then also make money where the customer does not pay off the TV at the end of that 12-month interest-free period. And so in the case of this fictional Harvey Norman transaction, the client then goes from interest-free period of interest of 0 to 29.5% with a monthly fee of $6. So the average transaction size is about 1.6K, so generally a piece of household equipment. And they have an average 90-day delinquency of around about 1.7 of their loan book, which is substantially higher than a bank. For example, sort of the major banks there, loan delinquencies are also around about 0.3 of a percent, so 0.3%, so much lower. But you'd expect that, 0.3% of the loan book. So you'd expect that given the customer base that they're targeting.
And they also, so 0.3 versus 1.7, but the interest they're charging is 29.5%.
Yeah, and there's also very little security. The resale value on a 12-month old TV is not very high.
True. Now, the critical part that Benjamin Graham alluded to was the timing of the IPO that has come to market. So why are these PE partners selling?
Yeah, so one of the things we look at really closely is when an IPO is what's the company doing with the money they're raising? If they're using the money they raise to grow the business and expand it and grow earnings, that's often a very good sign. Where it's being used to pay down the previous owners, that's not often a good sign. And the classic example of that is the Myer float in sort of 2014, where it was used to for the private equity owners to sort of to sell down and sort of run away, and that obviously incentivized them to get every cent that they could. So post the IPO float, the equity owners are going to take about $1.2 billion off the table. But however, after the IPO, these three will still own about 54% of Latitude. This is a bit of a hangover from the Myer IPO debacle, where investment banks advise private equity owners to actually hold a stake in the company post the float. However, investors should expect further sell downs in the future, with this stake in Latitude only in escrow until August next year. So we'd expect a bit of a sell down next year from these guys.
It's a pretty tight escrow at August 2020.
Yes.
Now, very tight. Has Latitude been impacted by the rise of other services in this area, like lay-by or buy now, pay later credit facilities?
Lay-by? You're dating yourself there, Chris. It's all afterpay now, mate. So, so Latitude's business has been pretty stagnant over the last 4 years. And at the same time, sort of smaller, more tech-savvy retail finance companies such as Afterpay, Zip, and Flexi Group have taken market share of Latitude because they're essentially competing for that same customer base, which I mentioned before. So that consumer earning less than 40K with limited access to sort of credit, that's Afterpay's sweet spot. So sort of increasing penetration in the online sales is a threat to Latitude, with the bulk of their loans generally being made in-store, and their technology platform seems very much behind Afterpay. So you have to imagine that the private equity partners are looking at the future, next sort of couple of years, where if they want to compete with Afterpay, they've got a substantial investments in technology, or they end up continue to lose market share to these sort of more nimble, tech-savvy retail finance companies.
Well, an extension of those more nimble, tech-savvy companies, the question becoming profitable, because Afterpay and Zipco are very much tech companies where investors are wondering about the profitability. Is Latitude profitable?
Yes, but not particularly. And going through the prospectus, it was a very complicated prospectus, north of 400 pages. The accounts were a bit tough to decipher. So Latitude's profitability is expected to jump quite rapidly. So in 2017, it earned 17 million. 18 it earned 44. It's expected to have a slight loss in 19, but a big jump in profit to $75 million in 2020. And the major component of this is an expected fall in Latitude's interest costs.
So that's are they basing that off rolling debt from higher rates to new, longer term, lower rates? Is that the main?
Yes.
Right. So that's a lot of profit to swing on just based on interest costs. Is that a reasonable forecast?
I mean, interest rates are coming down. However, after analysing hundreds of IPOs over the years, it always pays to be very wary of IPOs that promise sort of big jumps in profitability just after listing, as this sort of rarely occurs. I mean, conceptually, if a company was poised to almost certainly deliver a jump in profit a year or two after the IPO, the vendors would have an exceptionally strong incentive to wait another year before listing, as they dramatically increase their exit price, because the IPO is a multiple of profits. So, I mean, more recently, you might remember HealthScope and Spotless all had sort of big jumps in profitability that were intended to occur a year or two after listing. Neither of those occurred, and consequently, both of the share prices were sold off very heavily when the companies did not meet those targets.
So, following Benjamin Graham's advice, there we might take a fair dose of skepticism with these numbers.
Yeah.
If we extend this out for the rest of the company, what are the major risks that stand out to you when you look at this IPO?
Yeah, so looking at Latitude and the nature of its business model, Latitude's principal source of funding are the financing of its products, the warehouse trusts, which are about 60% of their funding, and being able to issue asset-backed securities on receipts for consumer products. And that's about 40% of their funding. So these warehouse facilities, you probably haven't heard this term for about 10 or 12 years. It was very much in vogue 2008, 2009. That's when I first learned about them. These are effectively sort of lines of credit that give Latitude the ability to borrow from a group of banks for a certain period. These are all generally sort of quite short term, with facilities expiring in 2020, 22 and 21.
So how does that risk play out for investors?
Well, the key risk here is the whole business model assumes these warehouses, because remember, Latitude, similar to GE Money, is not a bank. They don't have a depositor base. They can't issue term deposits or checking accounts to have funds to fund their business models. Their business model assumes those warehouses will always be open and restocked by their banking friends at favourable rates. This is an assumption that got Rams and Adelaide Bank into a lot of trouble in 2007 and 2008. Those sort of, in fairness, Rams had a much tighter spread of warehouse maturities, but however, in the GFC, these were not renewed. So investors have to be wary that if there's a substantial dislocation in credit markets, this could be a very unpleasant situation for Latitude.
So then we need to look at the economic environment, and how do you see Latitude sitting in this current state?
So it's probably an exceptionally good environment for Latitude right now. It goes back to the point you made a little bit earlier about the timing of an IPO. Latitude is obviously at the moment has done very well with Australian unemployment at its lowest level in 50 years. That's very good for a consumer finance company. However, rising unemployment will increase Latitude's bad debts, and we will see rising unemployment at some stage. And also sort of ongoing revenue, as in if Latitude's customers are seeing dark clouds on the horizon and losing jobs, or indeed sort of having their shifts reduced, they're unlikely to sort of go into Harvey Norman and sort of and stump up for a new television or washer dryer. Additionally, sort of Latitude is exposed to sort of negative trends in consumer credit, with a lot of the millennials favouring Afterpay's buy now, pay later for financing purchase over the internet. And that's sort of over Latitude's traditional business of a customer rocking up to a Harvey Norman in Bondi Junction and consumer financing a TV. So that'd have to be a bit of a concern for potential shareholders getting into this IPO.
So not just economic environment, but also that technological shift of consumers and their habits. Then we come finally to the price. So you've done the numbers, you've read the 400 odd pages. How do you view that price, Hugh?
So, I mean, the IPO for Latitude is only for about 35% of the company, and that's being offered around about 2 to 225. I imagine it's probably going to go off right down at the bottom of that. It's going to be priced in mid-October. So that values Latitude at around about $3.5 to $4 billion. So it's going to be a big company. And on these numbers, which I think we talked about, we have some questions about how accurate these numbers are, because given the expected jump in profitability next year, That puts Latitude around about 12.5 to 14 times in price earnings multiple, and sort of a yield of around about 4 to 6. So that looks okay, but I think sort of given a lot of our sort of concerns, yeah, I have some questions about those numbers.
So what are your final thoughts on this Latitude IPO, Hugh?
Well, I mean, Chris, history doesn't repeat itself, but often rhymes. And going through the Latitude prospectus, there are a range of similarities that could be seen 12 years ago when I was looking through the Rams prospectus, and thankfully said no to that one. It's a financial company that's built on arbitraging the difference between wholesale and retail interest rates, and ultimately dependent on the goodwill of banks and the markets just to continue to lend to them. So whilst the price earnings multiple looks attractive in the context of the Australian market, there are just too many warning bells for Latitude to be included in the portfolio of the IPO price. And additionally, with 65% of the register destined to be sold next year or the year after, it's really hard to see Latitude share price having a sustained rally from the IPO price over the next year. We'll be sitting on the sidelines of this one. This is one to avoid.
Thank you very much, Hugh Dive from Atlas Funds Management with an objective view on the Latitude Financial IPO.
Thanks a lot, Chris.